in case you missed it on The Pulse.
I think the idea of wait and see and pause is really yesterday's news. Our best advice to CEOs right now is that if you're not operating differently than you were a year ago, you may be falling behind. Yes, we need to build resilience, but we need to also build growth despite the environment, and that requires a different strategy than just a year ago.
Don't miss The Pulse, live every weekday.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. Let's focus in on European banks here. It's been a wild week when it comes to what's going on in Spain. Banco Sabadell fighting to block a takeover bid by BBVA, most recently calling 2 shareholders meetings as it looks to approve 1, a dividend, and 2, authorized sale of its UK unit, TSB. They've recently agreed to sell it to Santander upon shareholder approval. Is it enough to fight off the BBVA bid, though? Benjamin Toms, European banks analyst over RBC Capital Markets, has been following this story very, very closely. Benjamin, it feels like a question now of enticing the shareholders. Carlos Torres Villa over at BBVA has made it very clear that a TSB sale from Sabadell would not change the takeover bid at all. What do you think is going to happen here? Is this enough to keep shareholders on Banco Sabadell's side?
Well, thank you for having me to start with. This is a story that's on a knife edge, and I really don't think there's much in it at the moment. We saw earlier this week Santander purchasing TSB. That gives Sabadell some firepower. What it means is they're essentially offering shareholders a large dividend next year. In return, they're asking them really not to tender their shares to BBVA when that tender process starts probably next month. So it really is on a knife edge here.
Can you just walk us through maybe the synergies? If BBVA is still looking to acquire Banco Sabadell, it can't integrate it for 3 to 5 years, potentially ever. What is the point of acquiring Banco Sabadell? What is BBVA thinking here?
Yeah, I think if you think about the transaction from a long-term perspective, it really does make sense to merge together 2 Spanish banks. It will really give BBVA more firepower in their home market of Spain. But the synergies in the deal today just cannot be the same as they were when they were presented over a year ago. It's really difficult to see that 850 million is obtainable. And even if it is obtainable, money has a time value. And the government has made it clear that a lot of those synergies can't be achieved unless we're outside a 3 to 5 year window. So investors really have to make a choice with BBVA. In our view, they should really be pushing and doing a buyback here because that's giving shareholders money today. If not, they have to wait around quite a long time to achieve those synergies. There is no way they can achieve 850 million of synergies now, in our view, and that will bring down the ROI of the transaction.
It's fascinating as well because I think one of the key pieces of this, as you look at Banco Sabadell shares, they're already trading above where BBVA has offered to take it over at. And I think it's fascinating that they can do that. Whether it stays there is a completely different story. Talk to us about how Santander plays into all this. With the TSB sale to Santander, there's been some speculation here of whether Santander is indeed threatened from a market share perspective when it comes to a combo of BBVA and Sabadell. Is that a viable threat to Santander?
Well, you're right here. If you look at the value, the price that was paid for the TSB asset, in our view, it was a good price that was paid. It was slightly high. And probably that's because Santander were getting a 2-for-1. They were getting a good UK franchise, which was relatively easy to bolt on. But what they were also doing was scuppering the deal that BBVA was trying to execute in Spain with Sabadell. So yes, Santander would have been wary about what BBVA was able to do in Spain, and this TSB deal is an effective way of kind of helping them block that.
Talk to us then a little bit as well about, you talk about the synergies here between Banco Sabadell and BBVA. My understanding of the $850 million, a lot of that has to do with getting rid of jobs, of branches, to really going in onto digital banking, which feels like the same strategy that Santander is using for TSB. Basically rip it out from its foundation and rely more on the digital operations. Is that a fair comparison?
I think there's differences between the UK and the Spanish market. So BBVA has shown over the years that it is actually a very effective digital operator in Europe. It's one of the best banks in terms of their digital capabilities. Part of the story around synergies is going to be around headcount reductions, and it's going to be around branch reductions. I think you'll find that's probably easier for Santander in the UK than it would be in Spain. In the UK, branch numbers have fallen significantly over the last 10 years, and they'll continue to fall as we go forward from here. And that's because we're a pretty branchless society now. There's only a few people in society that actually need to use branches. In Spain, it's a little bit different. Branches are still a relatively important part of banking. So there's a little bit of a nuance, really, between the two geographies. But digital, for sure, is a really important factor in consolidation in Europe at the moment. If you think about banks' cost bases, about 15% of that cost base is spent on tech, and scale is really, really important. And that's kind of one of the reasons, one of the core drivers why we're seeing an integration and M&A and consolidation across Europe.
It's fascinating. We'll see how much of that is baked into the digital story. Benjamin Toms of RBC Capital Markets walking us through the pros and cons of this deal and where the money actually is. We thank you so much. Still ahead, going right back to the story over in Washington. Donald Trump's tax bill is moving forward, due to sign this afternoon in the States. We're going to dive into the details soon. Stick with us. This is Bloomberg.
Foi a mais terrível que eu passei na minha vida. Porque no final, tudo é dinheiro.
I think she's a scam up to now.
I am a winner.
I didn't really understand what I was getting myself into.
Money can really transform people's lives, but it can also hurt them.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/find treatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/find treatment.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. Let's stick with what's going on in Washington, though. House Republicans scored a major win for President Trump, getting his big, beautiful bill across the finish line.
Very simply, the one big, beautiful bill will deliver the strongest border on earth, the strongest economy on earth, the strongest military on earth, and ensure the United States of America will remain the strongest country anywhere on this beautiful planet of ours.
House Speaker Mike Johnson now sending the bill to President Trump, who's expected to sign it at the White House today. Bloomberg's Suzanne Lynch has been following the story closely from Brussels. She joins us now. Suzanne, walk us through the risks of this bill. There's a lot of fiscal investment that's looking to make this country, the United States, stimulative at the end of the day. What are people worried about when it comes to this bill?
Yeah, I think there's probably a short-term and a long-term perspective here. In the short term, some investors, banks think that this could be the kind of quick stimulus that the United States needs right now, and it's going to be good. But on the other hand, the CBO, that's the Independent Congressional Budget Office, has estimated that this could add $3 trillion to the federal deficit over the next decade. So obviously, you know, there are worries about how this is going to be sustainable and what it means for the U.S. debt levels and for the U.S. deficit. Now, politically, it's been very interesting. The Republican Party, Donald Trump's party, has traditionally been the watchdog for this, has taken very seriously concerns about the debt and deficit. In this case, they have decided to back this. Now, of course, we know the votes were quite tight, but it did get through. So Donald Trump has notched up a win on this. And let's see how markets respond fully when we're back in business in the U.S. Early next week.
It's a fascinating one. Suzanne, I'm going to put you on the spot here. Forgive me. We're getting headlines that Vladimir Zelensky said he had a call with Donald Trump, calling it fruitful, and he raised the prospect of Russian attacks on the call with Donald Trump. Very quickly, Suzanne, how is that being received, that relationship being received in Brussels?
Yeah, I mean, this is because Russia has bombed and attacked Ukraine again overnight. So there's a sense that Russia, Vladimir Putin, is digging in, not retreating in any way from Ukraine. And so this would be seen as a positive sign that the lines of communication are open between Washington and Kyiv.
Certainly something we're going to be keeping a very close eye on. Bloomberg Suzanne Lynch joining us from Brussels. Thank you so much. Coming up, we're going to talk a little bit about the private market. Stick with us. This is Bloomberg.
nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. Now, the markets are closed in the States. They are celebrating. I'm going to try to get my words right here, the July 4th holiday. But the markets are still moving. They're selling off on this Friday. Light volume, light liquidity across the board. Stoxx 600 down about 0.4%. They are actually off their lows, which I think is interesting, given you're seeing a series of risk-off sentiment when it comes to Washington, yet perhaps some carve-outs for the Swiss government, and that may actually be helping this stock market on this side of the ocean. FTSE 100 in the meantime marginally higher. You've seen it may have a major sell-off this week in terms of the drama from Downing Street, recouping some of the losses on that weekly basis. But when you look over at the States, S&P futures are still down about 0.6%. It is certainly risk off there. Let's talk about the cross-asset picture here, though, because you are also seeing the dollar sell off today, and you're seeing that show up in terms of a boost for euro dollar, still at a 117 handle, just shy of 118. Cable just shy of 137, so it did lose a little bit of its momentum, but 136 on the pound in this environment, not too shabby. A boost into gold as well, higher by 0.2%, and Brent crude in line with that risk-off sentiment, trading at a 68 handle. That's what's going on in the public markets. I want to talk about what's going on in the private markets, because as people are maybe enjoying this July 4th holiday, there is still this broader macro theme of how the private markets are showing up in this economy. Hugh Van Steenis, an expert on the subject, vice chair over at Oliver Wyman, joins the program. Hugh, a pleasure to have you. Thank you so much for making time and joining us this morning. You are an expert on private credit, and I think this is a really important topic that so many people are talking about whether private credit is the next big thing or starting to look bubbly, given that they are stepping in to areas of financing gaps that they never have in about 15 years' time. Walk us through the dynamics of private credit that are standing out to you.
Oh, well, thanks for having me on, Kriti. Look, I think it's the market is broadening and deepening. I mean, obviously, it used to be the preserve really about mid-market lending and leverage finance. And let's say from the financial crisis till the pandemic, we grew about $1 trillion parallel system investing in those two areas. What we've really seen in the last 5 or 6 years is a growing into asset-backed lending. And in particular, that's fueled by insurance money. So this is investment-grade assets, providing a loan to a data center, to an airport, to infrastructure. And that's just a much larger category. So, for instance, in the States, that's about a $5.5 trillion size market, of which private credit only has about 5%. And so I think as they pivot into these fresher pastures, there's plenty of opportunity, even if maybe in some of the areas of leverage lending and mid-market, there's obviously going to be so like anything in credit, there'll be some good situations and some bad situations. But I'm really struck after the biggest increase in interest rates in 45 years, it's actually been surprising how well this sector's performed given all the stresses and strains.
What do you think that's a testament to? Is that simply a testament to how big some of these players behind the scenes have gotten, that they're able to weather that despite that rise, I should say, in interest rates? Where's that coming from?
So it's a great question, Chrissy. So I think it kind of depends. So some of this is maybe cherry picking the types of sectors that private credit was lending to, a little bit less cyclical, a little bit more steady and resilient firms. So there's an element of of cherry picking of the companies they're lending to. I think that there was clearly some clever restructuring as well when there were some difficult situations. But I think it's in a way isn't this the story of this year? The resilience of the American economy and the resilience of American business against what's been a very dynamic and changing backdrop. And so I think in a way it also speaks to the broader resilience that we've seen in the economy. But I think but this pivot though, towards the newer sectors. This is new, and I guess we haven't yet tested it, but it does look like there's quite a long runway to go.
You're talking about it from a sector perspective, Hugh, but I'm curious how this shows up in a regional space. There's a big question here in Europe about how much of the sovereign financing gap is being covered by not only the private credit players, but the private equity players as well. Is that the new role that private markets play, this idea that when the banks can't provide that financing, the private players can?
Oh, it's a great question, Critty. So I think, look, one of the dominant questions I get from central bankers and regulators is, isn't this just another cyclical system? And I think the way we think about it, and we've discussed this before, is that, banks are 10 times levered. Private credit is typically, an institutional portfolio can either be unlevered to maybe 1 to 2 times levered. And so there's much less leverage in the system. So they're a lot less top heavy when the wind is, when there's gales around them. But I think you're right that they're increasingly looking to be a parallel system. So take the 18 months after SVB failed, private credit did 85% of the lending to the leveraged finance market, up from maybe about 50% the year before. So it was a counter-cyclical source of stability and diversity. We don't have as deep a market in Europe. And I think one of the key things that many firms I talk to are excited about is whether Europe starts to reform, maybe slowly at first, but maybe with a bit more momentum. And the reforms announced around securitization recently are at least a good litmus test that there are changes coming. Let's be honest, for the firms I engage with, the EU's moved far further than people originally thought, even if they would still like them to reduce friction further. So I think the ability for private credit to lend into parts of the economy, maybe could help with defence, but maybe providing finance to other sectors in the economy. I think this is a very exciting area. And of course, the other area that we haven't discussed is what happens about the wealth market. Now, and I think that's an area which I think is really is very exciting in the States, but is also starting to come to Europe.
Well, talk to us a little bit then about, you talk about the systemic risk here and maybe the lack thereof. And there's an argument that perhaps this doesn't affect the the financial markets in a dangerous way to the same extent because it is ultimately illiquid, protected kind of asset or part of the markets. Some would argue that is kind of the beginnings of a bubble or something similar that we've seen in terms of even the mortgage crisis, in terms of illiquid assets that aren't systemic until they are. Hugh, how do you think about that? How do you answer that question to people who are saying private markets are growing way too fast, way too quickly, they're looking like a bubble? What do we do?
Look, it's a great question. So I think we need to take a step back and say, will there be some bad decisions made? The history of the universe says clearly there will be. Like in everything in investing or in banking, there's some good decisions, some mediocre ones, and some bad ones. So I don't think we can change human behavior nor change the way people make their decisions. But we can certainly make an impact on whether it's systemic. The challenge about whether it's the financial crisis or the role of banks during the Eurozone crisis was that these institutions were right at the heart of the economy and were incredibly levered and dependent upon deposits. And let's just think, it was only less than 3 years ago that the US basically de facto guaranteed all deposits in the States after SVB and other banks failed. What we have here, at least, is a system which is much less levered, and the asset liability, the difference between the source of funding and the source of the lending is much closer. So for me, it's not that there isn't some risk. It's just that it's not systemic. And so I think that, we can never get rid of an economic cycle. We can never get rid of bad decisions. But what we can do is dampen the impact of it ricocheting through the economy. Yeah. And I think the people who worry about private credit being a systemic risk are probably exaggerating.
Hugh, speaking of the reverberations, and a final question to you here very quickly, there has been a concern when it comes to the private markets that when you see major endowments like Harvard, Yale, Georgetown, even UVA most recently over in the States, that their liquidation of private assets creates more supply in a market that's already struggling with capital markets that aren't as open as they'd like them to be. How risky is the fact that endowments are now trying to liquidate their private holdings?
Oh, look, this is a great question. So, look, I think that what we're going to test here is how much is there an ability to recycle risk from those people who need to sell to those people who've got the capital to buy. So it could be a sovereign wealth fund, could be another client with significant wealth. And so what we're starting to see is a recycling. Certainly as the numbers that I've seen for the really good funds which have got great investments, they're only trading at a sort of, 7 to 10% discount to NAV. So in other words, a bit of a haircut for selling, just like selling your house, but not a big one. Obviously, there were also some funds who are maybe launched in 2019, spent a lot of money before interest rates went up. Some of those are trading at 30, 40 point discounts. And I think this is just like any asset market. What we need to see is a recycling of risk. You're starting to see that repackaging. I think there's a much more fundamental question, Kriti, though, is 60% private the right model for an endowment? And I think in retrospect, some of the endowments probably felt they've now probably got too much money in venture capital and private equity, and it's rethinking and rebalancing the amount of illiquidity they have versus the needs for capital. And of course, the university sector is going through some significant challenges, and therefore they need some cash.
Hugh, it's fascinating that some of these endowments, talking about 16% is potentially too much in private when public investors are saying 60% is too much in stocks. Hugh Van Steenis of Oliver Wyman giving us some of the insight when it comes to those private markets. We thank you so much. Coming up, U.S. Treasury Secretary Scott Bessent saying there's no cause for concern over the recent U.S. dollar declines. We're going to give you part of our interview with him coming up next. Stick with us. This is Bloomberg.
In case you missed it on Balance of Power.
Administration officials have maintained today that the objective was solely to focus on Iran's nuclear capabilities, that this objective was not regime change. But, sir, even if it wasn't the objective, could that still be the end result, and how?
I think regime change has to be the objective because the Ayatollahs are never going to give up their pursuit of nuclear weapons. They have to be forced out of power. That's the only shot we have at really lasting peace and security in the Middle East. And a strike like this, and potentially others, can disrupt the regime, can destabilize it. Look at the choice that the top military officials and key Ayatollahs now have to face after the U.S. attack. Now they have to make a choice. Do they want to take on a second military adversary in the form of the United States? They may well do it, but they would be making a big mistake from the point of view of regime survival.
Don't miss Balance of Power live every weekday.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. U.S. Treasury Secretary Scott Bessent dismissed concerns about the recent decline in the dollar. In an interview with Bloomberg TV yesterday, he said the price of the dollar is not tied to the administration's strong dollar policy. Bloomberg's Matt Miller and Romaine Bostick spoke with him. Let's take a listen.
Number one priority is making sure the American people understand that this bill is the route to parallel prosperity. It is the best of what we saw in the 2017 Tax Cuts and Jobs Act, along with President Trump's campaign promises: no tax on tips, no tax on overtime. 85% of seniors will not be paying tax on Social Security, and the deductibility of auto loans if the car is made in the United States. It also funds the president's agenda in terms of defense, border, and school choice.
There's salesmanship that you and for that matter, the other cabinet members will have to do to the public, but there's also salesmanship that you have to do here, Scott, for the markets. There's a lot of concern about that addition to the federal deficit, the idea of a widening of that deficit because of some deficiencies in paying for some of those tax cuts. What is your message to the market?
Well, Romaine, I'm not quite sure what you mean, because stock market's at a new high, and the bond market just had its best 6 months in 5 years. So I disagree with that. So I think the markets are telling us that they like the bill and that they believe that it is fiscally prudent and stimulative for growth. And importantly, I think we can get back to the kind of growth that we saw in President Trump's term, 2.8, 3.2% non-inflationary growth, which the Biden administration was not capable of.
Mr. Secretary, Matt Miller here. I'm wondering, as someone who grew up with Alex P. Keaton, watching Milton Friedman on Phil Donahue, and always thinking we were on the wrong side of the Laffer curve, why haven't these kind of massive tax cuts worked to really stimulate growth in the past? And they certainly haven't worked to replace the amount of revenue that's taken out. We didn't see that with the Reagan tax cuts. It didn't work out with the Bush tax cuts, and it didn't work out with the TCJA in 2017 either. Why is it going to work now?
Well, I would disagree with TCJA. TCJA was a work in progress, and then we hit COVID. And I think what's different here also is we're going to be constraining spending. I spend a lot of time with the Freedom Caucus members, and their constituents should be very proud of them. They should be very proud of themselves. They changed the center of gravity of the debate. So we are both going to stimulate the economy, pick up tax revenues, but more importantly, constrain and pull down spending.
So far, though, it looks like we're going to boost deficits up to 7%. You ran on this 3-3-3 plan, 3% deficit, 3% economic growth, and 3 million barrels of oil, an increase of 3 million barrels of oil a day in the U.S. Do you expect to get to that by the end of President Trump's term?
I do, and I'm not sure where this 7% number is coming from. Right, because I reject the CBO scoring, but on the other side, the CBO also scored tariff income at $2.8 trillion. So that substantially increases government revenues. I think the growth is going to be much higher, and I believe that what we've done in constraining spending here is just the first bite at the apple.
Do you anticipate, Mr. Secretary, that the U.S. government's financing needs, the Treasury's financing needs, will increase over the next couple of years?
I think that we will see what happens to interest rates, and there could be an increase in financing needs based on yields, but everything that I'm seeing says that inflation is under control and likely coming down.
There's, of course, the cost to finance that, and we look at where yields have been, and we know there's been a lot of volatility there, some stability in recent weeks, partly because of some of the things that you've done and said publicly. But we've also seen a little bit of reticence to buy into longer-dated U.S. Treasuries. I know you have been public about the idea, at least in the short term, of relying a little bit more on shorter-term Treasury issuance. Do you anticipate that will continue?
Well, I think what we're going to see is one of the underreported things of the One Big Beautiful Bill is it also gets us away from this terrible debt ceiling dilemma. And because of that, we've had to constrain issuance. So it's likely that initially we will use bills to refill the Treasury general account.
Do you worry about any potential rollover risk in that strategy?
No, I don't. We've seen very durable and robust Treasury auctions. I see who the buyers are. I think that we are going to see U.S. banks would take up more of the debt issuance because of the supplementary leverage ratio relief that they're going to be getting.
U.S. Treasury Secretary Scott Bessent speaking with Bloomberg Television. Coming up on the program, Iran expelling all of the UN's atomic watchdogs. That conversation next, and what we can expect from the Iranian nuclear program. Stick with us. This is Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Forum in Central Portugal, and this is Bloomberg.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findstreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back to Bloomberg Markets. I'm Kriti Gupta. The United Nations atomic watchdog pulling out its last remaining inspectors from Iran. Sources telling Bloomberg that all 274 inspectors have been expelled from the country. Joining us now is Mark Champion, joining us from Bloomberg Opinion. Mark, just walk us through what this means for the Iranian nuclear program.
Well, you know, essentially, you had these inspectors in place. They conducted some 500 inspections this year. They are the source really of two things. One is a lot of information that we have as to what exactly the Iranians are doing, the ability to prove to what extent that they are or are not, enriching uranium up to weapons grade. They're not perfect, but they are a very significant, window into what the Iranians are doing. So when they go, we are essentially blind. We do not know where their roughly 400 kilograms of 60% enriched uranium is. That's a stockpile. There may have been a lot of damage to the uranium enrichment program that's been done, and it will have set them back. But nevertheless, we've lost track of that now. And without the inspectors, it's difficult to see how we find it. So it is a very significant move. It also closes the door on diplomacy, because that is the tool that you would need for any kind of verification.
Well, speaking of diplomacy, Mark, I'm curious about where Europe stands in terms of the standoff between Iran and the United States. Yes, we have a ceasefire with Israel, but it feels like European leaders have had more of a channel to speak and negotiate with Iran than the United States has. Is that a fair assessment?
Well, yes, they have, and that's been the case for a very long time. The so-called EU3, Britain, France, and Germany, they began the initial talks with Iran after its program was exposed back in 2002. So you began this set of talks. They brought really took the lead right up to when President Obama sort of stepped in order to get the JCPOA over the line in 2015. And since then, the Iranians and the Europeans have kept channels open. They were conducting talks right up until the recent bombing, and they are also always a channel that it is available there. It's just that at the moment it isn't quite clear what they can do so long as the Iranians have kicked out the IAEA, the inspectors. And it remains to be seen, really, whether we're looking at leverage by the Iranians or a sort of walk away.
Mark Champion of Bloomberg Opinion telling us where the relationship stands. We thank you so much. Let's turn right back to markets here, because speaking of Europe and where they stand, let's talk about their relationship with China. Remy Cointreau, Pernod Ricard shares sliding after China announced it would impose anti-dumping duties nearly 35% on European brandy. Morwenna Kanayem of Bloomberg is all over that story. Morwenna, so we had these headlines, we saw the market move, and then we saw exemptions on these very tariffs and duties that they implied. What are we supposed to make of this?
Well, essentially, the companies that were going to suffer the most from those anti-dumping tariffs on brandy agreed to minimum pricing with China. And so essentially means that things are going to have to be sold at a slightly higher rate than they were, but it's not the same as the level of tariffs that were being threatened. And we did see a rebound in those stocks. In fact, things like Remy Cointreau are actually higher now. Pernod Ricard, one of the better performers actually on the French stock exchange. At the beginning of the day, it really was a weight on the Stock 600 overall, those French stocks, and we've seen that sort of coming back throughout the day. So I think it's a case of it's not what the companies want, and they've been saying, they regret that this is a situation, but it's certainly a lot better than the worst-case scenario for them that they have been able to reach some agreement.
It's fascinating that this is coming, of course, as well as they did have a summit. They had negotiations they were trying to do. We also saw EV tariffs as a part of that conversation. Morwenna Kanayem watching these markets for us, watching that relationship for us. We thank you so much. She'll be back, of course, in the next hour. Coming up on the program, we're going to catch up with Matt Pavich, Revionix Senior Director of Strategy and Innovation. A conversation about this tariff policy, how it shows up in these markets, how it shows up in the world of technology. That conversation next. This is Bloomberg.
For Trump to win, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good educations, and latest technology. That's the only way to go. Education not contribute much profit for FPT, but from the country point of view, that's most useful contribution what FPT should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you are leapfrogging?
Yes, exactly.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's 11 a.m. in New York, 4 p.m. in London. Welcome to Bloomberg Markets. I'm Kriti Gupta. And of course, the U.S. markets are closed for the July 4th holiday. There's still plenty of headlines coming out of Washington, though. President Donald Trump says he'll start sending out letters today to set tariff rates with some as high as 70%. Meanwhile, in China, they're imposing an anti-dumping duties on European brandy as tensions escalate between Beijing and Brussels. Meanwhile, back in D.C., Congress passes Donald Trump's multi-trillion-dollar tax and spending bill. He's set to sign it this afternoon. Now let's get a quick check on these markets here, how they're digesting the events of the week in the last 24 hours or so. The Stoxx 600 down about 0.4%. The FTSE 100 is flat, though, really pairing some of the weekly losses from the drama down in Downing Street as well. But S&P futures, light volume, light liquidity, risk sentiment is still off on both sides of the Atlantic, down about 0.5%. Let's get a quick check on the cross-asset picture as well, because the dollar continues to weaken. Euro dollar at 117, just on the cusp of 118 as well. Cable at 136. It hasn't fully recovered to those 137, almost 138 levels from earlier in the week just yet, but give it time. Maybe it will. Gold, in the meantime, bid by about 0.2%, and Brent trading lower by about 0.7%. Turning back to our top headline, of course, we are counting down the days between that July 9th deadline when it comes to the tariff story between Donald Trump and the rest of the world. He says he will start notifying trade partners today of new tariffs on their exports effective August 1st. Bloomberg's Brendan Murray is all over the story, been following it very, very closely. Brendan, on the one hand, Europe has to deal with potential tariffs from Washington. They're also in negotiations with China right now. The U.S. and the Swiss seem to have a friendlier dynamic with both sides. What is the biggest risk right now? What negotiation is what we should be watching for?
Well, you're going to have three basic outcomes. You're going to get a deal, you're going to get a delay, or you're going to get one of these letters that President Trump is threatening to send out. Those letters are going to go to the countries that either haven't brought him a good enough deal or no deal at all. And he laid out the reciprocal tariff levels that he wanted to impose on all of these countries, and it's going to be painful. It could go to countries that don't that the U.S. doesn't rely on them that much, but they would rely on the U.S. a lot for their exports. So we don't know any of these countries by name yet, but President Trump said he's going to start today with 10 or 12. Could be another 10 tomorrow, another 10 on Sunday, and so on until they get to the 56 countries that he started with 3 months ago, who are going to either get a letter, get a deal, or get a delay.
There's been some speculation, some commentary around the level of as high as 70%. Is that fair? I mean, what do we think about when we talk about the range of percentages, the range of potential tariff rates here?
Well, it's the percentage would speak to the amount of leverage that the president wants to apply on you, and if he goes at you with a tariff like 70%, which would essentially cut off all of your trade with the United States, then he's sending a very clear message that you need to bring a better offer. Now, he's also going to factor in that, you don't want to shoot yourself in the foot with tariffs this high either. But certainly 70% was 20 percentage points higher than anyone he initially announced. So we'll see who's going to get 70%. But remember, these tariffs, whether we're talking about the reciprocal ones or the sectoral ones, they stack on top of each other. So countries could wind up with a fairly low reciprocal rate, but they could have to factor in auto tariffs and steel tariffs and eventually pharmaceutical tariffs to get to levels that would look like 70%.
It's that stacking that's almost more dangerous than the actual rate itself. Brendan, don't go anywhere. I want to bring in our other guest, but I want to keep you right here just in case and stick with us. Matt Pavich, Senior Director of Strategy and Innovation at Revionics, joins the program as well. Matt, I want to bring you into this conversation Brendan and I are having here around what this tariff picture looks like going into July 9th. Talk to us about how the market should be interpreting it, given we've got, again, very touch and go since Liberation Day.
Yeah, so I would say definitely from a U.S. retail perspective, the consumers haven't seen it yet, right? So it's been kind of a up and down where to some degree it's hitting retail, but the consumers are worried about it, but they haven't seen it at the actual shelf yet. And a lot of that is because a lot of the products that consumers are buying are actually products that were purchased before the tariffs, and with all of the on and off strategies and the delay and the pause on the tariffs, retailers have been kind of in a holding pattern as far as how are we going to make major strategic decisions around this, because they simply don't know what the tariffs will end up at for a lot of countries. Now, having said that, we have seen, in Q1, we've seen some signs that, the tariffs have impacted, consumers and retailers here. We've seen, drops in consumer sentiment. If you look at, the U of M consumer survey, that was, approaching 80 in January and then dropped down in the 50s. It came up a little bit in the last report. We also see the large drop in consumption in the latest GDP revision. And obviously consumption is highly tied to retail. And then, you can see retailers reacting as well. They're down playing some of their forecasts for later in this year. They're announcing that price increases are on the horizon. You're getting that from major retailers, including ones that have built their reputation in a lot of ways on pricing. So we can see a lot of signs that, things are coming, and the consumers are also bracing for the tariffs as well.
Well, Matt, talk to us about how much appetite and digestibility some of these consumers have. I'm thinking about if I went out, just anecdotally as a hypothetical, went out and want to buy a pair of sneakers, for example, or trainers, as they call them over here on this side of the Atlantic, and I see, let's say, a 5 or 10% rise on $100 worth of sneakers. I don't even think trainers go for that these days. But hypothetically, is that fundamentally going to be changing the purchasing decision I'm going to be making? I'm curious if there's a view here on what that line of the sand is where consumers actively change their behavior.
Yeah, definitely. And we're already seeing some of that change in behavior as well here in the U.S. Obviously, there's, this big risk of increases on some certain categories, especially things like trainers, sneakers, whatever. I think they're even called different things in different regions of the U.S. These are categories that if we look at back to school shopping behavior data, for instance, Foresight recently released a report on U.S. back to school consumers. We're seeing a lot of pull ahead behavior. So consumers have said that they are going to buy products in June and July because they're worried about tariffs in August and September as the school year approaches. And that has increased pretty significantly. It's up like 9 percentage points of, wanting to pull ahead sales. We're seeing that in some other areas as well. And we're also seeing an increase in consumers looking for promotions. We're seeing a whole lot of pull ahead activities also being sponsored by retailers. You look at the extended Prime Day events and all the competitive responses to Prime Day. They're elongated, a lot of heavy promotions. I think a lot of consumers are trying to buy things now and a lot of retailers are trying to pull ahead some of their financial metrics. So if they have a bumpy ride in the second half of the year, they'll be in a little better place.
Matt, you brought it back to school shopping, and I want to hone in on that because there was all this fear around Liberation Day that by the time kids have to go back to school and shop for their notebooks, there would be empty shelves and they wouldn't be able to do it. And that Walmart, for example, back to school sale would just not be what it traditionally is. Has that timeline for the consumer pushed down to maybe holiday shopping or beyond?
Yeah, we're going to see that more in the second half of the year. I think the risk was real when we saw some of the elevated tariffs before they were put on hold. You could see it with the shipment and container traffic going, into the U.S. from China when the tariffs were at 145%. You could also see massive concern in a lot of surveys and consumer data. KPMG had a consumer pulse survey in April, right at the peak of the Liberation Day announcement and all of the aftermath. And you saw, 70% of consumers expected a recession in the next 12 months. 79% expected prices to increase because of tariffs. I think the putting the tariffs on hold is what kind of prevented us from having the empty shelves that, would have been expected had those tariffs been in place. So I do think, though, as new things are rolled out and new decisions are being made and new tariffs are being applied, we're going to see the impact starting to hit in the supply chain. And we're also going to start to see it with prices because we do know, inherently as tariffs hit, prices are going to go up. And these are just on products that come from other countries. If you're in the U.S., products that are made in the U.S. using foreign ingredients like, chocolates that are made in the U.S., but, the cacao comes from Ivory Coast or Ghana. And even in the longer term, you're going to have impacts with things that are grown in the U.S. because a sizable percentage of our agriculture comes from using potash, which primarily comes from Canada, and the tariffs on that are going to impact that. So I think, it's going to hit different segments and different products at different times. But we do know it's coming. Consumers are preparing for it. Retailers are preparing for it. And I think that, we'll have to see how it shakes out with some of these announcements in the next several days in terms of tariff policy.
Matt, hold that thought. I want to bring in our trade reporter, Brendan Murray, back into the conversation. Brendan, we're seeing a redhead cross the Bloomberg terminal here. The car makers are seeking to offset tariffs as the EU and United States trade talks near an end. You and I have been talking about this for a couple of hours now in terms of the auto tariffs that are being put on here. Just walk through it for our global audience. Where in Europe you see the most exposure?
Well, certainly Germany and France, who have the big auto industries, are going to be putting pressure on the officials in Brussels to try to figure out an arrangement, whether it's a lower tariff or some sort of quota system that can allow them to get through some of the barriers that President Trump is trying to put up. European automakers have offered to open up production lines in the U.S. They've tried to, meet Trump halfway on this, but this is really where the rubber is going to meet the road, so to speak, in these trade talks in the final few days. Is can the Europeans get any relief for these industries that are struggling in many ways against Chinese competitors and are trying to ensure that they can keep their sales vibrant in the U.S. This is going to be one of the key factors. President Trump has often said, why don't we see Fords and GMs driving in the streets of Berlin? So this is something that goes back a long way for Donald Trump. He has the same issue with Japan and its protections on its domestic auto industry. So the news that we're seeing as the EU and the U.S. trade talks really get down to the nitty-gritty is going to come down to these issues that really mean a lot to local politicians, and they're not going to give much ground that they don't have to give.
Absolutely. It's a fascinating one as well. Can you imagine Fords on those big trucks on a German road? It's quite the image. Brendan Murray, our trade reporter, giving us some of the breakdowns there. We thank you so much. Matt, I want to come right back to you here with a final question. On the auto sector specifically, we've been talking so much about consumer goods and kind of whether or not they're willing to buy those pair of sneakers, for example. Does that behavior change with more expensive items? If car prices go higher, is the sensitivity higher as well, or are we still seeing that digestibility with consumers?
I mean, across all industries, automotive, retail, elasticity is a really important thing, and understanding how consumers will react to certain pricing moves is a critical element for a business to understand when deciding how to react to tariffs, right? In the retail space and in the automotive space, it's important to understand, which products consumers are, more elastic, meaning they will respond more negatively toward price increases, and which products are more inelastic, meaning, if you raise the price, it won't impact your volume as much. I think the critical thing in all sectors, retail, particularly, and automotive, is that, you have to have the right price on the right products for your consumers. And that really comes down to listening to the data, looking at the analytics, understanding what they're doing with their purchasing behavior, and where, you absolutely cannot take your prices up. Or even if, you get hit with a major cost increase, you have to play it really smart, because it's a competitive market. Consumers are hurting. They're worried. We're seeing that in the numbers. So we have to make sure to manage price perception at all time, regardless of the industry you're in.
It's certainly a fascinating one, as we just showed our global audience. One of the markets are very much reacting to. Matt Pavich of Revionics joining the program with a little bit more insight. We thank you so much. Coming up on the program, President Trump gearing up to sign his spending bill into law. We're going to dive into the details and the ramifications of the One Big Beautiful Bill. Stick with us. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
How do you expect the asset to continue price increase at these levels that we've seen? And at what point do we see, winter coming again?
Winter's not coming back. We're past that phase. If Bitcoin's not going to zero, it's going to $1 million. And you have all the evidence you need to determine that, right? The President of the United States has determined he supports Bitcoin. The cabinet supports Bitcoin. Scott Bessent supports Bitcoin. Paul Atkins has shown himself to be an enthusiastic believer of Bitcoin and digital assets. Ken Taz at CFTC feels the same way. The banks are going to custody Bitcoin. Bitcoin has gotten through its riskiest period. The accounting has been corrected. There's now only 450 Bitcoin a day available for sale by natural sellers.
Don't miss Bloomberg Crypto live Tuesdays.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. Let's go right back to what's going on in the States. House Republicans scoring a major win for President Trump, getting his big, beautiful bill across the finish line.
Very simply, the One Big Beautiful Bill will deliver the strongest border on earth, the strongest economy on earth, the strongest military on earth, and ensure the United States of America will remain the strongest country anywhere on this beautiful planet of ours.
House Speaker Mike Johnson now sending the bill to President Trump, who's expected to sign it at the White House today. Bloomberg's Roz Matheson covering the story for us. Roz, this was such a tricky bill to get across the finish line. So many concerns around the deficit and how much worse it could get with the spending package. What changed?
Well, that's right. I mean, this was a very big bill, and it was a complex bill, and that made it also extra tricky to get it through the House, through the Senate, then back through the House, as we've seen. And it was a close call because a bill this big and complex can divide people. And what you had was the challenge of some Republicans who were saying, hang on, we're not cutting spending enough. We are, as to your point, we're going to increase the deficit. We're increasing spending. This is not good. And other Republicans saying, hang on, you're cutting too much. You're cutting especially around benefits, Medicaid, and that's going to hurt us potentially coming into the midterm elections with voters. And so you had these two opposite ends of the Republican sphere pressuring on the bill. And so the challenge was to get enough of them to sign on in the end from either side to get this thing through. And yet they did. And a large part of that was probably due to just, again, the personal power of Donald Trump, very invested himself, heavily involved himself, publicly so, warning Republicans in a way that if they didn't support the bill, that they could regret it come midterms. And he would remember that. So using his own influence there, perhaps to coax people over the line. But you can still see a lot of concern bubbling up as a result of this outcome, as you say, around things like the level of spending, the deficit, and what kind of precedent it also sets going forward.
It certainly is an interesting one. How is it being viewed in Europe here when, at the end of the day, yes, there are massive increases in terms of the actual deficit, but it's also funding over $4 trillion worth of tax cuts when it comes to the next 10 years. How's that being interpreted on this side of the Atlantic?
Well, it comes at a time when the economic data, I mean, we saw jobs data recently, have generally been pretty good and signs of resilience in the US economy. There's been a lot of concern about sentiment hits, about inflation and so on, and perhaps those are yet to come. But right now, the economy is holding up pretty well, and so is the US market. And that's good, really, for everybody around the world. And that's how Europe is viewing it, is a sense that, okay, the US engine is doing okay. I mean, obviously, there are concerns about how this starts to filter through down the track. Do you start to see shifts in consumer sentiment as some of these other changes come on board, and that perhaps the immediate impact of all these tax cuts being extended and new tax cuts coming starts to fade off? You know, does that impact the US economy? A bit of concern there, but also perhaps equally another opportunity in Europe, because you've seen, of course, this bill is going to roll off all of the Joe Biden era green credits for EV subsidies, but also for a lot of green projects. And if that's going to disappear, is there an opportunity for European companies to look at that and say, how can we maximize it over here as a result? No longer are those areas being subsidized effectively by the US government. So there may be some opportunity for European companies there.
It's a really fascinating one as well. Something that we're going to be watching in terms of where the trade negotiations go and whether the tariff revenue actually makes up for those tax cuts. Bloomberg's Ross Matheson joining the program, giving us a breakdown of that tax bill headed for Donald Trump's signature later today. We thank you so much. Still ahead, we're going into the European banking sector. Banco Sabadell is fighting to block a takeover bid from BBVA. They think they could do it, selling TSB to Santander. Some interesting dynamics when it comes to the banking consolidation story and what it means for Europe broadly. We're going to dive into the details next. This is Bloomberg.
Welcome back to The Circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate. Put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Kriti Gupta. One of the main conversations happening here in Europe is the question of consolidation. And one key case that's catching a lot of eyes on this side of the Atlantic, Banco Sabadell fighting to block a takeover bid by BBVA. It's been in the works for over a year, looking to raise some cash, maybe give it to its shareholders after selling its UK unit TSB and seeking to approve a dividend when it comes to convincing shareholders to stick with Banco Sabadell instead of accepting BBVA's offer. Covering the story for us is Bloomberg's Jennifer Serrane this afternoon or morning if you're in the United States. Jenny, walk us through what this story means. There's a lot of drama from the Spanish banking sector, but I think it highlights a broader issue of we need banking consolidation in this region to grow, but there's real resistance from it. How do we square the two issues?
Yeah, it's an interesting one. I think you've seen a lot of both bankers and politicians, lawmakers arguing that in order to properly compete with the likes of a JP Morgan, a Citigroup, a Bank of America, Europe's banks need to get bigger. They need to consolidate. They need to kind of combine forces and get stronger. But then when you're actually here on the ground, you see a lot of resistance from targets, like what we were just talking about with Sabadell. You see them kind of pulling out every trick in the book to try and avoid being this takeover target. And so it's really hard to see how we'll ever get to kind of bigger and stronger European banks that can really compete with the likes of the Wall Street giants.
It's a fascinating one as well, because we were talking to our analyst earlier, Benjamin Toms over at RBC, about the whole point of Santander taking on this TSB deal. And there was a lot of concern when this was announced that Banco Sabadell would kind of sell off TSB to perhaps fundraise as well. Walk us through the Santander side of things. How useful is this for Santander to have TSB on their books?
Yeah, no, it's super interesting because we've actually seen from Santander, there's been a lot of investor questions about, are you really committed to the UK? Is this the right time to be piling in? But they've been really adamant that, the UK is a strong market for them. They like that it's a little bit more stable, especially when they've got the big Mexico exposure that can kind of go up and down. The UK is sort of the ballast for a lot of their earnings engine. And so you've seen them be a little bit less, they have a little bit less scale than some of the other big UK banks. And so this kind of gives them that scale and really sends a message to the market that they're serious about the UK and they don't want to be, viewed as wishy-washy on this market at all.
It's a fascinating one as well. Jenny, I know you used to be, of course, a U.S. banking reporter as well. That's what's going on in Europe. Meanwhile, in the States, they've just passed a lot of their stress tests. They're increasing their dividends. Is this peak shareholder returns for the U.S., or is there more coming?
I mean, I think when you have a president who's really committed to deregulation, you could certainly see more coming. So certainly in the last week, you had the stress test, you had some of the rolling back on the SLR. It's another fun capital requirement for these banks. And so you've seen them already get to really release a ton of this capital. You see shareholders getting excited. You see that in the stock prices. But with an administration like the one you have, I don't think that this is the end. I think we're only at the beginning.
So it's a fascinating one. Bloomberg's Jennifer Serrane walking us through the banking sector on both sides of the Atlantic. We thank you so much. Coming up, Fiona Cincata, senior analyst over at Citi Index Financial Markets, is going to be joining the program next. And in the meantime, we are seeing these markets sell off on this Friday. Markets closed over in the States, but futures down 0.6%. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
In case you missed it, on The Pulse.
I think the idea of wait and see and pause is really yesterday's news. Our best advice to CEOs right now is that if you're not operating differently than you were a year ago, you may be falling behind. Yes, we need to build resilience, but we need to also build growth despite the environment, and that requires a different strategy than just a year ago.
Don't miss The Pulse, live every weekday.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Welcome back to Bloomberg Markets. I'm Kriti Gupta. Let's go a quick check on how these markets are performing. It is, of course, a holiday over in the United States for the 4th of July. That isn't stopping U.S. futures from trading, though, down about 0.6%. You are seeing the Stock 600 also down by a similar margin, down by 0.5%. The FTSE 100 virtually unchanged at the moment. The Stock 600, however, paring back some of those losses from earlier. The kind of revisions, it feels like, or caveats when it comes to the U.S.-Swiss trading deal seems to be pulling it off of its low. So that's going to be one we watch very, very closely. Let's take a quick look at the cross-asset picture, because euro-dollar is at about a 117 handle, pound at 136. You're seeing a bid into gold as well, higher by 0.2%, and Brent crude trading at a 68 handle. Lots going on in these markets. We probably have a little bit of a risk-off vibe going into the long weekend in the States, of course, and a shorter weekend here in Europe. Joining us now for a little bit more analysis, Fiona Cincotta, senior analyst over at Citi Index Financial Markets, joins the program. Fiona, pleasure to have you on this program. Thank you so much for joining us. We're trying to kind of drink out of a fire hose right now when it comes to trade negotiations, when it comes to the tax bill and the implications there. And on top of that, a little bit of monetary policy just to keep things spicy. What is top of mind for you, Fiona?
Yeah, great question. You know, I think as we end this week and we're moving into the next week, we've seen that sort of the reaction to the non-farm payroll has sort of quickly given up. So, I mean, attention, I think, is quickly turning to the 9th of July and that trade tariff deadline. That's causing this sort of jittery vibes in the market today. We're seeing that slight risk off that you pointed out, the sort of futures down, gold pushing higher. And I think there's just a lot of uncertainty still regarding what to expect. I think it's quite interesting, the positioning that there is as we go into that deadline. Given that we've sort of had that update today that some letters might be going out to trading partners, tariffs could be anywhere between 10% to 70%. So there is still a lot of uncertainty, but I think that decoupling between US stocks and the US dollar that we've seen recently is just really interesting. US dollar obviously down towards that 3.5-year low still. US stocks up around record highs, although we've said the futures are down slightly today. You know, there's still a massive divergence between the pictures that we've seen in the FX market and in the equities market.
It's fascinating that you're talking about this divergence, because there's a big question here of whether a weaker dollar is incentivizing international flows into the United States, if that's actually helping the case for the S&P 500. What do you think? Do you think that's something that would entice enough foreign investors to get in on the S&P 500?
Yeah, I think that's definitely helping. I mean, we do sort of see that weaker dollar as making it a more attractive proposition for US stocks and increasing demand for US stocks. I think it's going to be really interesting, though, whether this is able to hold up as we sort of approach those concerns over deadlines for Trump's trade tariffs. Because, you know, if we just cast our mind back to April when we had that initial reciprocal tariff announcement on Liberation Day, there was a sharp sell-off. Now, I'm not necessarily expecting anything like that next week. Obviously, we need to keep in mind that liquidity tends to be thin in these summer months, so there could be some volatility. But I just wonder whether we will see a little bit more of that Sell America trade coming through next week if we do have high tariffs coming in from Trump, just because it may be offsetting or seeing investors just question their exposure to US stocks. We might see more of a diversification, particularly geographically speaking.
Well, Fiona, it sounds like, especially in this kind of perhaps end of U.S. exceptionalism narrative that we're seeing, when it comes to the trade story, it feels like the idea of caveats or carve-outs for when it comes to some of these trade deals. We just saw it with Switzerland, for example, in the last couple of hours when it comes to the pharmaceutical tariffs, may be a pillar of the way these negotiations move forward. Do you trade that in the FX market or the stock market? What is a more liquid asset when it comes to trading volatility?
Do you know, I think given the where we are in the year, given that we're sort of in these summer doldrum months, which I think can be difficult for liquidity, I think that does mean that potentially it does favour towards the FX markets, just because there are certain FX markets which obviously have greater liquidity at this time of year. The stocks can struggle a little bit in that respect. So I volatility, so the volatility that we could see on the back of this, though, is something that I'll be watching out for. I think that does mean that the FX market is where I'd be looking to trade those this more on the Trump's trade deals.
There's also a question in the FX market if being short dollar is a consensus trade, if we're due for some sort of dramatic shift, in the opposite direction. Given that 6 months ago we were still talking about euro-dollar parity, now I'm looking at almost 118 on euro-dollar. Is this market primed for a more violent retracement?
Look, as you pointed out, you know, this is a really interesting position that we are halfway through the year. I mean, the first half weakness, or the weakness that we've seen across the first half of this year in the US dollar is quite exceptional. I mean, it's, you know, historical. It's something we've not seen since 1973, such a weak performance for the US dollar index. But I think looking out across the remainder of the year, so looking out across the second half of the year, I think there is a potential for the US dollar to remain weak. I think that could be a trend that stays with us. Just because if we think about these factors, we've got the potential for these trade deals to be creating a lot of uncertainty towards the US and its outlook. We've also got sort of the big beautiful bill which has just been passed at the House of Representatives, which I think is also affecting those concerns over the fiscal outlook and raising fiscal concerns as far as the US is concerned, particularly with that debt pile, which could also keep the US dollar under pressure, just undermining the US dollar there. I mean, we've obviously seen that non-farm payroll data, which was stronger than expected. But again, it wasn't really amazingly strong. So it's not that it just completely removes any potential Fed rate cuts for this year. You know, I think we're still on track for 2 Fed rate cuts this year. With this in mind, potential for erratic policies from Trump. The euro looking quite favourable still, even at the 118 levels. It has rallied quite considerably since the start of the year, but I think there is still potential for that to continue. And even the Japanese yen, I mean, a lot depends on what we're going to see with the trade deal, no trade deal, 35% tariffs. Will the Bank of Japan be able to continue hiking in the way that they want to if that comes through? But that is also the safe haven trade. So I think there is a potential for the yen to benefit there. And also I think gold is another area that we're going to see potentially remain strong as we head across the rest of the year.
Fiona, when you talk about haven bids, you talked about gold, you talked about Japanese yen, the dollar's lack of haven quality perhaps a little bit as well. You didn't talk about the Swissy, though, and I think that's really interesting. And when we're talking about that kind of idea of a momentum push that isn't necessarily driven by the fundamentals of the country itself, we know that the S&P has recently cut to zero, and there's a question of whether negative interest rates need to be put back on the table. Is that a case study that perhaps Japan or the United States should be following in terms of currency strength driven by haven flows?
Yeah, that's really interesting. I mean, that demand that we have seen for the Swiss franc has been pretty phenomenal. Again, on those safe haven flows, even as you mentioned, as they're heading to negative interest rates. So I think that is an interesting one. I mean, it does mean that potentially even for the yen, there is room to see the Bank of Japan not hike interest rates and the Japanese yen still appreciate further. As far as the US dollar is concerned, I mean, I do think it still has safe haven qualities, but I do think at the moment we've seen very much when the disruption is related to Trump's erratic policies that the US dollar is completely out of favor. We did see in the Middle East when we saw that sort of revival of concerns, of geopolitical concerns in the Middle East, the US dollar did get that safe haven vibe back, but that has swiftly evaporated again. No, I don't think that the US dollar is going to be able to benefit in the same way that we were able to see the Swiss franc benefiting at the moment, and potentially the Japanese yen could benefit further from.
All right. Fiona Cincotta of Citi Index Financial Markets driving us through many of these cross-asset trades. We thank you so much, and happy 4th to you as well. Coming up on the program, we'll go right back into the trade story, but from a little bit of a different angle. China imposing duties on European brandy shipments. Part of our interview with French Industry Minister Marc Ferracci on the escalating tariff battles. We're going to dive into that next. This is Bloomberg.
This villa, very traditional, a lot of things of the past.
I live my very first independent life in the farmhouse, and I built it by the memory of the farmhouse, the philosophy they believe, yin yang 5 elements, the concept of the life, of the happiness. They build this kind of roof like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress. I changed during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about. David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Welcome to Bloomberg Markets. I'm Kriti Gupta. China imposed anti-dumping duties on European brandy for 5 years while exempting major cognac makers. And earlier today, French Industry Minister Marc Faraci told our very own Caroline Conan that it's essential to de-escalate the tariff battles. Take a listen.
We shouldn't be happy with what was announced today by China, even if some agreements can be found. But I think that there are a lot of jobs, thousands of jobs that are at stake with the cognac industry. Many parliamentaries, many MPs talk to me about what happens in their constituency with cognac. And I think that we all must find a way to de-escalate this trade war with regards to cognac, but also with regards to all the tariff issues.
Another, obviously, big deadline is July 9 for the US tariffs. We may have some letters from President Donald Trump today sent about these US tariffs. Do you think that if the EU settles with 10%, is that a good deal for Europe? Should we just settle at 10% and be done with it?
No, I don't think that's a good deal. I don't think that's a good deal because previously we were at 2, 3, 4% of tariffs in many industries, and all the value chains were organized by taking into account this level of tariffs. So I think that 10% is not a good deal, and I think that we all should find a way to get back to the former situation by negotiating with the United States and the US administration. And I think that's the goal of the Europeans should be to get back to the previous situation, the previous tariff levels. And I think that to achieve this goal, we need to stay united. You need to be very firm in our answer, and we need to take into account the actual impacts of the tariffs on value chains. And I give you an example. In aeronautics, the big plane manufacturers have value chains that are very much integrated between the US and Europe. And as from 1979, there are no tariffs at all in this specific industry. So all the value chains are very much integrated with no tariffs. 10% tariff for this industry would be a nightmare.
France has a digital tax on some US giants. At the moment, France has said they are not planning to withdraw this digital tax. But do you think that could actually potentially become one negotiating tool in these negotiations?
Well, I think that we made decisions in the past few years about this digital tax. And we think that it is an important component of our tax policy because it makes sense economically, politically.
So it's going to stay?
Sorry?
So it's going to stay?
Well, I got no announcement to make today, but I think that it's part of the overall negotiation. And I think that, as we all know, the US firms, the US companies are very strong on the digital, and many European firms depend on the US technology when it comes to digital. So we also have to take this fact into account, the fact that taxing the digital may have impacts on the value chains, but we are very much aware of the fact that this tax is an important tool of our tax policy.
So which industries are going to be the most affected by these new US tariffs?
Well, it's quite difficult to say. Some industries have direct impacts on them because they are exporters to the US. But you have another phenomenon which is quite concerning to us, is the redirection of Chinese flows that were targeted to the United States and that now are coming to Europe. And as we all know, China has built overcapacities in a wide array of industries, and it makes it quite sensitive and quite dangerous for our industries to see this redirection of Chinese exports.
French Industry Minister Marc Ferracci and Bloomberg's Caroline Conan in Aix-en-Provence earlier today. Coming up, we're setting you up for next week's trading week. What do you need to know in the markets? What do you need to know in the political story? We've got you covered. Stick with us. This is Bloomberg.
In case you missed it on Balance of Power.
Administration officials have maintained today that the objective was solely to focus on Iran's nuclear capabilities, that this objective was not regime change. But, sir, even if it wasn't the objective, could that still be the end result, and how?
I think regime change has to be the objective because the Ayatollahs are never going to give up their pursuit of nuclear weapons. They have to be forced out of power. That's the only shot we have at really lasting peace and security in the Middle East. And a strike like this, and potentially others, can disrupt the regime, can destabilize it. Look at the choice that the top military officials and key Ayatollahs now have to face after the U.S. attack. Now they have to make a choice. Do they want to take on a second military adversary in the form of the United States? They may well do it, but they would be making a big mistake from the point of view of regime survival.
Don't miss Balance of Power live every weekday.
Mais serviu que eu passei na minha vida. Porque no final, tudo é dinheiro.
I think she's a scam up to now.
I am a winner. I didn't really understand what I was getting myself into.
Money can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. The United Nations Atomic Watchdog is pulling out its last remaining inspectors from Iran. Sources telling Bloomberg that all 274 inspectors have been expelled from the country. I want to get a little bit more analysis here. Bring in Mark Champion of Bloomberg Opinion. Mark, thank you so much for joining us today. Talk to us a little bit about the precedent that this sets for other nuclear programs around the world.
Yeah, I mean, this is, in general, this is all very worrying for the Nuclear Non-Proliferation Treaty. This is a sort of something that's set up after the war. It was designed to try and control the spread of nuclear weapons through diplomacy. About 190 countries signed up to it. Iran's one of them. And the idea is just to, create a mechanism to monitor and make sure that things stay civilian, if they're supposed to be civilian, and so on. And Iran agreed to some, increased surveillance under, previous agreements. And they have a large inspection program there. So if we then turn from, they expel the inspectors and we turn to trying to control the spread of nuclear weapons through force and through foreign intelligence agencies figuring out what's going on and then sending planes in and so on. It really changes the dynamic, makes other countries think about, well, how do I make sure that I don't get invaded, that someone doesn't send bombers in to, deal with what they think is our nuclear program. And the answer, unfortunately, probably is that they'll say, well, North Korea isn't getting bombed, Iran is.
Can you talk to us about what support, perhaps, Iran may get from the likes of Russia or even China, given the events of the last few weeks?
Yeah, I mean, the Iranians will get support in terms of their civilian program. They always have. The Russians are involved there. The Russians have no problem with the Iranians having a civilian-grade enrichment program. That was, the sort of basis line on which the 2015 nuclear agreement was agreed. And what's really changed now is the U.S. and Israel insisting that there should be no enrichment whatsoever. The Russians have no problem with that. So the Russians will help to some extent. They may help with, rebuilding their air defense if they can. The Russians are pretty consumed at the moment. The Chinese do have the wherewithal to do that. Where they probably won't get help is with trying to weaponize, because neither Russia nor China has a particular interest in seeing a nuclear-armed Iran, which is why they agreed to the 2015 deal.
It's a fascinating and dangerous story, frankly. Mark Champion of Bloomberg Opinion walking us through the dynamics off of the events in Iran lately. We thank you so much. Let's turn to the markets here because, of course, this was something the markets were very sensitive to. And in the week ahead, there's plenty to watch. Marwana Kaniam from our equities team is all over the story. Marwana, we know there's a trade story to be watched here, but there's also a UK political situation that continues to, I think, have everyone kind of on high alert for the UK assets. What is going to move markets in the week ahead?
Well, that's a good question. I think there's obviously a lot going on, and I think what happens over the weekend in terms of the geopolitical events will matter hugely. I think big things that are coming up next week, and it's not just UK specific, of course, it's the deadline for the tariff negotiations on Wednesday. So everyone will be focused on the US, but all trading nations for that. So that's particularly going to affect European countries. This afternoon, we've heard that they are sort of automakers in some countries are looking to get some exemptions on tariffs there. For the UK as well, we will have in focus GDP figures for the month of May, expected to show a bit of a pickup after a sluggish start to the quarter, but those overhanging concerns about the fiscal situation in the UK are not going to go away. And I think the outlook, you have to remember that so far the GDP figures haven't really reflected the impact of tariff concerns that hit the sort of market later in the spring. And so I think those will be coming through. Concerns about inflation still really will be weighing. And we're also going to have some bond sales, which will really test how investors are actually viewing the UK, because I think what we've seen this week is a lot of speculation and a lot of sort of jitters, and how it pans out in terms of weighing up the concerns about sluggish growth versus inflationary risk and the potential for a sort of widening deficit versus the prospect of tax hikes will, I think, be starting to be tested, and we'll hear a bit more about that.
It's fascinating. I wonder if there is a ripple effect from what the UK has to offer relative to the rest of the world. Is everyone heightened or senses heightened when it comes to the deficit story? Bloomberg's Marwana Kaniam walking us through that story and what to expect in the week ahead. That does it for us. Have a great weekend to the folks in the U.S. Happy Independence Day. Stick with us. This is Bloomberg.
case you missed it, on Bloomberg Crypto.
How do you expect the asset to continue price increase at these levels that we've seen? And at what point do we see, winter coming again?
Winter's not coming back. We're past that phase. If Bitcoin's not going to zero, it's going to $1 million. And you have all the evidence you need to determine that, right? The President of the United States has determined he supports Bitcoin. The cabinet supports Bitcoin. Scott Bessent supports Bitcoin. Paul Atkins has shown himself to be an enthusiastic believer of Bitcoin and digital assets. Ken Taz at CFTC feels the same way. The banks are going to custody Bitcoin. Bitcoin has gotten through its riskiest period. The accounting has been corrected. There's now only 450 Bitcoin a day available for sale by natural sellers.
Don't miss Bloomberg Crypto live Tuesdays.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Didn't really think I had a problem.
I would isolate, self-medicate. Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Hello, welcome to the Bloomberg Tech Summit. I'm Caroline Hyde.
And I'm Ed Ludlow. We are in the heart of San Francisco for this event, which is focused on the way technology fuels business.
We've brought together leaders from across tech and business to discuss how executives, entrepreneurs, and investors can create opportunities as they navigate the hazards and challenges of today's business world.
The race for artificial intelligence supremacy is upon us, fueling growth in infrastructure, investment, and efficiency. In other areas of business, quantum computing is inching closer to commercial use. Robots are entering the workforce.
Hi, Spot!
And everything from cyber threats to deep fakes are more sophisticated. At the same time, Silicon Valley has new allies in Washington, and these voices are shaping policy, influencing capital, and shaking up global relations. A new era is upon us, an era defined by explosive technological innovations, but also profound economic uncertainty.
They charge us, we charge them.
Who will lead the next wave? How will businesses thrive and adapt? And where can technology help push us forward?
Artificial intelligence is the single most important technology force of our time.
The rate and pace of change in the industry, it's like faster than anything we've ever seen.
You got to dream and execute.
At the forefront of nearly every conversation, artificial intelligence. From strategy to execution, AI is transforming how business gets done. And to kick things off, Bloomberg's Emily Chang sat down with Google CEO Sundar Pichai.
So investors are clamoring to know, but you haven't shared the specifics. How much money are you pouring into AI, and how much money are you actually making from AI?
Well, I mean, in 2025, our capex is $75 billion, right? So we are definitely investing for the long run. But, it's the same investment which powers businesses from search to YouTube to cloud to Workspace to Android and Play to Waymo, right? So I think it's such a profound technology. I feel the opportunity ahead is bigger than the opportunity we had in the past.
YouTube and the web more broadly is being overrun with AI-generated content. What effect is that having on Google products and services? Are you finding you need to allocate more resources to filter out the low quality content?
I mean, look, anytime there are these technological inflection points, it's always a cat and mouse game, right? So the new technology creates new opportunity, more people can create content, but you also have a rise in low quality content. I think moments like this is what we actually, it's what Google is good at, right? Separating, finding the needle in the haystack, making sure you surface the higher quality content. We are using Gemini to help improve YouTube's recommendations. So we are using AI to help improve how we direct content, etc. You know, there are good content being created using AI as well. So we're just trying to elevate high quality content.
You've said AI overviews are good for publishers. The publishers we talk to say it's tragic. Publishers say they can't opt out or they might be de-indexed from Google entirely. So what is the concrete evidence that this is actually good for them and not just good for Google?
A few things. I mean, I think compared to most companies in the world, we take care to design experiences which is going to showcase links, right? And we took a long time testing AI overviews and prioritized approaches which result in high quality traffic out. I'm confident that many years from now, that's how Google will work, right? Like, you know, we think the value proposition in Google is people come. Yes, sometimes they may get answers. That was true when we launched featured snippets many years ago. But people come back, people are curious, people are expanding their use cases, and people do seek out sources on the web. And we are going to prioritize approaches. Obviously, with AI overviews, the quality improves, the context we are giving users improve. What we are seeing is people are clicking and going to a more diverse set of websites, and they're spending more time on average per click.
I've heard you say a few times that you think of AI as an expansionary moment. But so far, it does seem to be favoring tech giants and well-funded startups with access to GPUs and data centers and enormous amounts of capital. Like, isn't this really concentrating power in fewer hands? And is AI just another winner-take-all game?
I'm confident there is a company that's going to be created with AI, just like when the internet happened. Many years after the internet happened, Google didn't exist. You know, there's no doubt to me that 3 years from now, there'll be a company which will be dominant in this AI age, which we don't even know the name of today.
Yep.
That's the only way things work in the future.
For those who don't know, can you tell us a little bit about what Perplexity is?
So Perplexity is an answer machine. You get answers that you can really trust. We were the first to reimagine search in the form of conversations and answers with trusted sources. And we did it in a way that essentially became the blueprint for every other chatbot out there. And so we kind of essentially built it as a tool we wanted, and our friends wanted it, our investors wanted it, and then we put it out into the world. Never thought about it as like, oh, like links, 10 blue links to answers. But once we put it out, that's when we realized, like, based on what people are saying, hey, this is actually like a much better way to like consume the internet. Yeah. Like, we're all living on the internet, and so I would rather just feel the internet through answers instead of links.
Got it. So yeah, you guys were really one of the first AI companies to do real-time AI search, focused on that and linking back. Now everyone's doing that, right? Including Google, including OpenAI. So what are you doing to differentiate, and why do you think browsers are the next frontier for successful AI companies?
The browser is the front end to your internet, like experiencing the internet. The Omnibox, the search box, is where almost all the Google queries are going. And if you really want to transition AI from answers to actions, to doing stuff for you, answers are essentially like 4 or 5 searches in one. Actions are like an entire browsing session in like one prompt. You really need to actually have a browser and hybridize the compute on the client and the server side in the seamless way possible. And that calls for rethinking the whole browser. We're not actually like thinking about Comet as yet another browser. It'll be a cognitive operating system. It'll be there for you every time, anytime, for work or life, as an assistant on the side, or like just going and doing browsing sessions for you. And I think that'll fundamentally make us rethink like how we even think about the internet. Like earlier we would browse the internet, but now people are increasingly living on the internet. Like a lot of our life actually exists there. And if you want to build a proactive, personalized AI, it needs to live together with you. And that's why we need to rethink the browser entirely. So investors are excited about the possibility of completely changing the front end in which we experience the whole web. And the web is so valuable. And the other thing that's most important to consider about Perplexity is we're the only company razor focused on all the accuracy aspects of AI. Like we really want us to be the accuracy layer for AI. And that's going to influence both human and AI decision making. And every day, like trillions of dollars worth of decisions are made across retail, finance markets, exchanges, everything. And if we can influence a big chunk of that, then that'll automatically means like we can be worth trillions of dollars in market cap one day.
I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts. I hope that when people are using our technology, our hardware, I want the experience of it not to be the hardware. I want the experience of it to be connecting with each other, connecting and being more capable, connecting with superhuman memory and vision and hearing that allows you to accomplish your goals more. Like that, it still should be an experience that is a software-motivated experience, but that would not be possible without this hardware.
Up next, the fun stuff, new technology and how it is impacting our lives.
I mean, AI changed the game for us because instead of having an engineer program what Digit would do, AI can now help teach it skills.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
This is Bloomberg Tech Summit in San Francisco. I'm Ed Ludlow.
And I'm Caroline Hyde. Throughout history, breakthrough technologies have consistently shaped the way businesses make decisions, fueling innovation, boosting efficiency, and sharpening competitive edge across industries.
From the steam engine and electricity to computers and the internet, each wave of advancement has redefined how companies operate, adapt, and grow.
So what's next? To help answer that, we begin with Uber CEO Dara Khosrowshahi and Bloomberg's Tom Giles.
The power we see in the Uber platform continues to increase. Now, what I mean by that is we have a relationship with you on the ride side. A lot of you using Uber to come here. Thank you very much. And then we